Generally, what investors do is buy assets like stocks, gold, or real estate and hold for the long term, expecting to either generate cash from the asset or sell at a much higher price later. How long term? As I said, there is no clear definition, but generally we are talking years. If investors are looking to purchase an asset that generates cash flow, like rent from a house or dividends from a company, then that is the purest form of investing, where you buy something that generates value for society and you receive a reward for that. It is a pretty simple concept that everyone can understand. On the other hand, if investors are looking to purchase an asset and then sell it at a later date for a profit, the line with trading becomes a bit blurred, but we will explore that in a bit. In that case, the investor is looking for something that is undervalued according to them, buy it, hold it, and then when they think it is overvalued, sell it and make a profit. If we are talking about a company, they try to calculate the intrinsic value of the stock. When they think their price is above the calculations of that intrinsic value, they buy it and wait for the value to catch up to the price and perhaps even overshoot, at which point they sell. That process might take several years. If it is real estate, then investors might look for an area that is likely to develop well in the coming years, buy a land or a house there, wait for the price to go up, and at a certain point sell it. Same with gold, cryptocurrencies, etc. You get the idea. Now, if the asset they are purchasing doesn't generate any cash, this type of investing becomes a bit more speculative and gets closer to trading. What do I mean? Well, if you buy stock like Amazon and you pay 30 times the yearly earnings, you might think it is below what the value of the company is, and you might wait for the earnings multiplier to grow from 30 to 40, at which point you decide it is overvalued and you sell. In that case, you have clear guidelines. However, if you buy something like gold, it doesn't generate any economic activity and cash flow, and so in that case you're purely looking at the sentiment of the market and the broader economic conditions in order to decide what the fair value is. Alright, this is what, in short, investing is. Let's talk about trading. As with investing, there is no clear official definition, but we can define trading as purchasing a certain instrument in order to sell it for a profit in the relatively short term without any regard for the underlying fundamentals. So, in our previous example, an investor would buy Amazon after analyzing their financial statement, their market position, etc., and might hold it for years because they believe in the company. The trader, however, will use a combination of different signals and tools to purchase Amazon stock and try to exit for a profit without any regard for the strength of the quality of Amazon. I know, it sounds a bit blurry, but it is because I'm trying to simplify it for you, and as I mentioned, there is no clear definition. Usually traders don't hold positions for long. With day trading, they literally may only hold them a couple of hours or even minutes. In swing trading, they will hold at least a few days and sometimes weeks or months. Regardless of the time horizon, traders don't generally care for the underlying asset or its long-term potential and only look to get in and out relatively quickly for a profit. This type of activity used to be reserved only for professionals, but with the change in technology in recent years, trading has become accessible to the everyday person, even from the comfort of their own home. For good or for bad, we will see by the end of this video. Before I go into the pros and cons of both, I think it will be useful to pay attention to some of the differences between trading and investing. As I already mentioned, a key difference is the time frame. Generally, investors are more long-term minded and are looking to hold a position for years, while traders will hold it only in the span of hours or days. Another difference is the mindset. When you are investing, you care a lot about the fundamental strength of the asset you're purchasing. You want to evaluate the business model if it is a stock, check the earnings of the company, market competition, etc., etc. Whereas if you're trading, you are completely okay with buying even complete junk if it will give you a nice profit within the next few days. One more difference I want to mention is that traders use technical analysis a lot more than investors, although in investing, looking at charts might help you make a decision as well. Technical analysis is the act of looking at the price action and charts of an instrument and make buying and selling decisions based on that information. This could be stocks, but also crypto, foreign currencies, known as Forex, etc. The other type of analysis you might hear about is fundamental analysis, which is used a lot more by investors because it evaluates the company's financial situation by looking at financial statements and also at the broader economic environment. It also pays attention to what's going on in the specific sector and any news related to it. This video is part of my guide I did on investing versus trading. To check the full version, click on the video that should have appeared on your screen right now.